Hi, my name is Jeff Witz. I'm the Director of Business Development at Medicus Asset Advisors.
And hello, my name is Julie Kazan, and I'm the Vice President of Financial and Investment Strategy at Medicus. For over 20 years, Medicus has been educating and advising individuals in the medical field. Our focus is on wealth management, which is made up of three components: investment consulting, helping you determine an investment strategy and mitigating investment risk; advanced planning, which can involve projecting retirement goals and steps to reach them; ensuring you have sufficient insurance coverage; making certain your estate planning objectives are met; charitable gifting strategies; and asset protection strategies. And finally, relationship management, ensuring all of the individuals who work for you, your financial advisor, your accountant, your attorney, your banker, are all aware of your goals and are working together to help you reach them.
So a few disclaimers we're always required to give. We are affiliated with a broker-dealer, Osdale Financial Partners, that allows us to buy securities and insurance products for our clients. And then we're also registered with the Securities and Exchange Commission, which allows us to provide wealth management advice and recommendations to our clients. So today is the second video in a series that we're putting together. If you haven't watched the first video, I'd encourage you to go back and do so. It covers a lot of the basic concepts and strategies around personal financial management. Today's presentation is really going to be focused on investing. Why is investing important? What are some of the key concepts when investing? And then we'll also talk about different account types and how you may be able to utilize them. So with that, let's take a look at our agenda. We're going to start with a case study to show you how much you may need to have saved for retirement and why it's important to start saving and investing for your future as soon as possible. We'll then discuss investment concepts and strategies, as well as go over the do's and don'ts of investing. Finally, we will discuss different account types and how you may be able to use them to your advantage depending on your goal. With that, I'll turn it back over to Julie.
Thanks, Jeff. Let's begin with a case study to examine the impact of various rates of return and inflation rates on the amount of money you will need to have saved to retire and maintain the lifestyle you would like. In this case study, there is an individual that would like to retire today, and they would like to have $5,000 in inflation-adjusted monthly income that will last 30 years. As a reminder, inflation is the concept that goods and services get more expensive over time. What $5,000 can purchase today is more than what $5,000 can purchase 10 or 20 years from now. If this individual wants to maintain their purchasing power, they will need to spend more than $5,000 per month in the future to ensure they are not losing purchasing power over time. So how much will this individual need to have saved to produce $5,000 per month in inflation-adjusted income for 30 years? Well, approximately $1.8 million. This chart illustrates the impact of investment returns and inflation on how much this individual will need to have saved to produce their desired income. If we assume that the rate of return on this individual's investment assets is the same as the inflation rate, the total amount of savings is $1.8 million. If the rate of return on their investments is higher and the rate of inflation is lower, they may not need as much as $1.8 million. For example, if this individual's portfolio produces an average rate of return of 6% and the inflation rate is 3%, they will need to have approximately $1.2 million saved. But if the rate of return is lower and inflation is higher, they may need more than $1.8 million. However, $1.8 million is a good estimate as to how much this individual should have saved today. Now, why may $1.8 million not apply to you? When will you be retiring? 5, 10, 20, 30 years from now? What's going to come into play between now and then? Once again, inflation. What $1.8 million can purchase today is more than what $1.8 million can purchase in the future. If you're not retiring today and would like the same level of income, you will likely need much more than $1.8 million saved. How much more will you need to have saved? Well, if you are retiring in 30 years, you will need to have approximately $4.39 million saved. How are you going to get there? Well, you need to have a plan in place to start saving and investing So compounding growth can do some heavy lifting for you. Compounding growth is one of the most powerful tools available for those trying to grow wealth. We hope the case study was helpful in putting into perspective the amount of money you will need to have saved to produce your desired retirement income. Now let's continue on and review some important investment concepts and strategies that can help you work toward your retirement goals. A few of these we covered in the previous session, but we think another review is worthwhile. Our first concept is compounding growth. It is a powerful tool to grow wealth over time. How does compounding growth work? Let's say you make an investment and it returns 6% over 1 year. The next year it returns 7%. That 7% will be not only on the initial investment amount you made, but also on the 6% it returned in the previous year. You can think of compounding growth as a snowball rolling downhill. With each rotation, the snowball grows in size and in momentum, and hopefully by the time you reach a financial goal like retirement, that snowball has grown to such a size and has so much momentum that it can produce the income you need to live the lifestyle you desire. Let's take a look at a more real-life example once again. In this example, there's a young couple, Rachel and Ross. Both of them are 27 years old, and they each have the opportunity to begin saving $6,000 per year, earning 7.2%. Rachel starts saving for her retirement right away. She saves $6,000 per year for 9 years until she reaches age 36, and at age 36, she decides she is done saving. She wants to start enjoying her money. So she is just going to let what she has already saved continue growing and taking advantage of compounding growth. Ross, on the other hand, is a spender. He likes to live a lavish lifestyle. He goes on expensive vacations. He bought a large house and a nice car. Eventually, Ross realizes he needs to start saving for his retirement. So at age 36, the same age Rachel stopped saving, Ross starts saving $6,000 per year and does so for the next 29 years. So what is the result so far? Over that 9-year period, Rachel saved $54,000 and Ross over 3 times as much at $174,000 over that 29-year period. So what is the result when they both reach retirement age 65? It's surprising, but Rachel has accumulated more assets in her retirement account than Ross. That is the beauty and power of compounding growth afforded to those who can start saving and investing early. Just the 9 years of extra rotations on Rachel's snowball had a huge impact on the amount of assets she had in her retirement account later in life. I'm sure you can imagine how much more Rachel would have in her retirement account than Ross if she continued to save all the way until her full retirement age. All seems pretty simple, right? Start early and invest your assets in a manner that can produce a long-term return based on an assumed inflation rate that will allow you to reach your spending goals. In reality, investing is much harder. An annual study is conducted that looks at the S&P 500 index, an index that tracks the performance of the 500 largest companies in the United States, and how it performed over a 30-year period of time. The study also looks at the average investor who was invested in a fund that mirrors the S&P 500 and how that investor performed over that same 30-year period. The average investor always performs worse. Why? Well, individual investors make mistakes. They try to time the market by predicting its movements to gain an edge, or they sell during times of panic or buy during times of growth. They let their own emotions and poor decision-making negatively impact their long-term goals. Another way of saying this is, you are one of the greatest threats to your investment performance. This chart shows that the overall market is most efficient, and trying to beat the market is a feat few are able to achieve. Let's take a look at some of the other top reasons for long-term investment loss. The first and most prevalent are euphoria and panic. We have already discussed a bit the impact that emotions can play on investment performance, but it's worth mentioning again. Euphoria and panic are the two biggest causes of long-term investment loss, as they are emotional reactions to what is happening in the market. You buy into market euphoria when things are going well, or you panic when things are going poorly. In these situations, you are buying high and selling low, which is the opposite of the fundamental premise of investing, which is buying low and selling high. And the reason you are doing this is you have succumbed to the emotions of investing. Other top reasons are investors can be afraid of change. Maybe it's an investment you have held for a long time and become attached to, and it may be a good investment, but it's important to regularly monitor and make sure it's performing to expectation. If not, don't be afraid to make a change. There are no bonus points to loyalty when it comes to investing for your future. Many investors also believe that information equals wisdom. We receive calls from clients all the time about a stock they just read about that's about to take off, or a medical device that will change the landscape. Well, that may be the case, but more should go into that investment decision than just what you read in an online article. There are publications today that are paid to either promote or bash a certain company or product, and it's difficult to know if you are getting unbiased and accurate information. It's important to run potential investment opportunities by your investment professional, and they should be able to tell you the strengths and weaknesses of that investment. Another common reason for investment loss is an investor can be under-diversified. If you have all your retirement savings in Apple stock and the next iPhone isn't very good and Apple stock tumbles 20%, well, your retirement savings also fell 20% along with it. It's important to be diversified. At Medicus, we assist our clients with doing this by investing in mutual fund and exchange-traded funds. For those unfamiliar, mutual fund or exchange-traded funds are baskets of securities that own hundreds or thousands of company stocks or bonds, and by investing in that one fund, you are essentially invested in all of those company stocks as bonds as well. The benefit is that if one of those companies has a bad year, you have the other 99% of companies in that fund to prop up performance. So diversification is very important. An investor can also be over-diversified. If you own 30 or 40 different mutual funds or exchange-traded funds, and you review the underlying holdings in these funds, you may see many of them own similar stocks or bonds, which can lead to unintentional over-diversification into specific companies, which can skew your overall investment strategy. And finally, you may also be paying a fee to either a fund manager or an advisor that is too high compared to the overall return you are receiving on your investment. It's important to understand how these individuals are compensated and ensure the fee that you are paying is justified relative to the service and or return you are receiving. Now that we've looked at the key reasons for investment loss, let's look at the key determinants of investment success. A Nobel Prize-winning study was conducted to determine just this. From this study, they found there are 3 key determinants of long-term investment success. 5% is security selection, which stocks, bonds, or funds you are using. 2% is market timing, the idea of buying low and selling high. And the other 93% is asset class selection and how well that asset allocation applies to you at different stages in your life. For example, when you are younger, you typically want a larger percentage of your allocation in equity categories such as large, small, and international company stocks, which can produce higher long-term rates of return, along with also having more downside risk. As you approach retirement, you transition a percentage of your investments to bond categories, which can have a lower risk profile, along with lower returns. What percentage of your investments you have in large, small, and international company stocks, along with domestic bonds, international bonds, and real estate, and how well those percentages align with the investment goals you have in various stages of your life are by far the biggest determinant of long-term investment success. And it's critical you get this right. If you are unsure how much you should be investing in each category, we are happy to help. Your risk tolerance, required rate of return, and time frame will determine which asset classes you should be invested in and what percentage of your portfolio should be invested in each asset class. Here we have provided some examples of asset allocation strategies individuals can implement based on their rate of return requirements, risk tolerance, and time frame until retirement. Please note everyone's investment needs are different, and these should not be taken as recommended changes, just as an example. In this portfolio, the assets are split approximately 90% to equities or stocks and 10% to bonds. It is fair to say that this is a fairly aggressive portfolio. This type of strategy will typically be used by an investor with a longer time frame and a high tolerance for risk. As an investor begins to approach retirement, they may start transitioning their allocation to be more bond focused. In this example, they move from a 90 to 10 equity to bond split to an 80 to 20 split. This allocation provides a bit more downside protection and likely will not fluctuate as much as the more equity-focused portfolio would during a market downturn. As this investor enters retirement or is in their later retirement years, they may transition their portfolio to an even more bond-focused allocation. With less years to stay invested, they desire less risk. However, as you can see, still a good portion of the portfolio is invested in equities in an attempt to still capitalize on upward market movements. As a reminder, these are just some examples, and to determine when you should start transitions from a more equity-heavy portfolio to a more bond-heavy portfolio, we recommend you speak with a financial professional and evaluate your rate of return needs and income requirements. And now I will turn it over to Jeff to review different types of investment accounts and their uses.
Thanks, Julie. Now in this section, we want to show you some of the different account types that are out there and how you may be able to use them to accomplish your goals. Really, there are only two broad account categories, taxable accounts and tax-advantaged accounts. We'll go into more detail on how these accounts differ in a moment, but first, a quick rundown of the most common accounts that fall into these categories. Under taxable accounts, you have individual accounts, which you individually set up and are the sole owner of. You have joint accounts, which is when you co-own the account, very common amongst married couples, but technically you can open one with anyone. Trust accounts are owned by a trust for the benefit of your family after you die. Finally, custodian accounts are typically set up so you can start saving and investing for a child. Under tax advantage accounts, you have 401ks, 403bs, and 457 plans, which are all retirement plans that your employer may offer. Traditional and Roth IRAs are established by you and separate from anything that your employer offers. A 529 plan can help you save for your child's college education. And finally, if you are in a high deductible health insurance plan, a health savings account can help you pay for some medical expenses. Now, why do they call them taxable and tax-advantaged accounts? Taxable accounts get their name because anytime you sell an investment that had an investment gain, you must pay capital gains taxes. There are two types of capital gains, short-term and long-term. The rate you pay is based on how long you owned the investment. If you own the investment less than 1 year, your gains are taxed at your ordinary income tax rate. If you own the investment longer than 1 year, capital gains are taxed differently. The IRS essentially says, congrats on your wise investment selection and patience holding it for 1 year. Instead of asking you to include your investment gain in your income and pay income tax on it, we will tax it at a long-term capital gains rate instead. Long-term capital gains rates are typically lower than your regular income tax rate. Possible capital gains tax rates are 0%, 15%, and 20%. The rate the IRS asks you to pay is based on your income that year. Take a good look at this chart to determine what your capital gains rate might be. Let's take a look at a quick example of how capital gains taxes may be calculated. Let's say you make a $5,000 investment. And over the next few years, you did quite well, and that investment doubled in value to $10,000. In this example, your investment gain is $5,000. You subtract the initial $5,000 you put into the investment from the $10,000 you ended up with when you sold. You never have to pay taxes on the money you put into the investment, only on the gain portion. Now that you have determined how much you gained, you must multiply that number by your capital gains tax rate. In this example, we used a 15% long-term capital gains rate. As you can see, when you multiply the $5,000 gain by 15%, you can determine that you owe $750 in long-term capital gains taxes. That may seem like a lot, but remember, you still have $4,250 left over after tax, or $9,250 when combined with the original $5,000 investment that you made. Now, when might you consider using a taxable account over a tax-advantaged account? Taxable accounts don't typically have the same age restrictions on when you can access the money in them, compared to tax-advantaged accounts, which may penalize you if you access the money before age 59 and a half, or if you take the money out for a non-qualified purpose. Most taxable accounts, you can access the money at any time, so they may be a good place to invest money you think you will need before you reach your retirement. There also aren't any caps on how much you can contribute to a taxable account. Tax-advantaged accounts like 401ks, 403bs, 457s, IRAs, and HSAs all have limits on how much the IRS allows you to contribute to them each year. No limits exist with most taxable accounts, so you can invest as much as you would like. Finally, the long-term capital gains tax rate may be lower than your income tax rate. With pre-tax, tax-advantaged accounts, which we'll talk about in greater detail in a moment, when you take money out of those accounts, you must include that money in your income and pay income tax on it. If you earned quite a bit that year, it is possible you may be in a high tax bracket. Instead of taking a distribution from your tax-advantaged account and paying at a higher tax rate, you may instead take money out of your taxable account and pay a much lower tax rate. We always recommend you consult with your CPA to determine what is the best option for you. Now, you may have just heard me say that tax-advantaged accounts may be taxed at a higher rate than taxable accounts, and you may be wondering to yourself if they got the names backwards. So, where do tax-advantaged accounts get their name from? In tax-advantaged accounts like 401ks, 403bs, 457s, IRAs, 529 plans, and HSAs, you can buy and sell in those accounts as much as you want without having to pay capital gains taxes. So while you are trying to grow the balance in the accounts, no tax is taken out when you sell an investment that had a gain. This allows more money to stay in the account and get reinvested. You heard Julie talk about the power of compounding growth. With these accounts, more money remains in the account due to not taxing the gains when an investment is sold, and allows that money to grow more substantially with compounding growth. That snowball can grow in size at a much faster rate. Now, depending on whether the tax-advantaged account is a pre-tax or Roth account, will determine if any tax is owed when the money is distributed from the account. So what is the difference between a pre-tax and post-tax tax-advantaged account? Let's take a look at the characteristics of each, the advantages and disadvantages of each account type, and when it may make sense for you to use one. Pre-tax accounts can sometimes be known as traditional accounts. So if you hear someone refer to an account as a traditional 401k or traditional IRA, they are referring to a pre-tax account. With pre-tax accounts, you put the money in before any federal or state taxes are withheld. The benefit of doing this is you keep more of your money, and it lowers the income you report to the IRS that year and have to pay income tax on. Once in the account, you invest the money, and hopefully those investments grow tax deferred. Again, you can buy and sell as much as you want in these accounts without having to pay capital gains tax. Now, you got a tax benefit when you put the money into the account by now reporting less income to the IRS that year. You also got a tax benefit as the money grew tax deferred. However, Uncle Sam always wants his cut, and this money has not been taxed yet. We have a saying that Uncle Sam is patient but not generous. So when you take a distribution from these accounts, you have to include the amount you distributed in your income and pay income tax on it. This can still be a pretty sweet deal because if you distributed the money in retirement, you are no longer earning your salary and may be in a lower tax bracket. So you avoided paying taxes when in a higher tax bracket when you contributed, and now pay taxes at a lower rate when you are no longer working. So with pre-tax accounts, you get a tax benefit when you contribute, a tax benefit while the money grows, but you have to pay tax when you take the money out. So who might benefit from contributing to a pre-tax account? It does require looking into a crystal ball a bit and trying to figure out your financial circumstances in retirement. But as we mentioned on the previous slide, people that expect to be in a lower tax bracket in retirement than they are in their working years would benefit from a pre-tax account. You avoid paying taxes while working and in a higher tax bracket, and instead pay taxes when you are retired and in a lower tax bracket. Now let's take a look at post-tax, often referred to as Roth accounts. With Roth accounts, you are contributing post-tax money. This means that you already paid state and federal taxes on the money that was contributed. Once in the account, the money is invested and grows tax-free. When you take a distribution from a Roth account in retirement, the distribution, including the investment growth, comes out of the account tax-free. So with a Roth account, you don't receive a tax benefit in the year you contribute, like you did with a pre-tax account, but you get tax-free investment growth and tax-free distributions. So who might benefit from a Roth account? Someone who expects to be in the same or higher tax bracket in retirement than they are during their working years. This can be caused by business interests that continue to pay them, investment properties, or investment income. Additionally, some people like to have flexibility in retirement. So if you are already contributing to an employer-provided retirement plan on a pre-tax basis, you may consider making Roth contributions to an account like a Roth IRA. Having a mixture of pre-tax and post-tax money can give you flexibility in retirement. Maybe 1 year in retirement you have a lot of income and are in a higher tax bracket. This would be a good year to take a tax-free distribution from your Roth account. You don't have to include this distribution in your income and pay income tax on it. It is distributed tax-free. Another year, you may have very little income and are in a lower tax bracket. This can be a good year to take a distribution from a pre-tax account and pay the tax at a lower rate. Having both account types gives you flexibility. As always, we recommend speaking with your CPA to determine the right strategy for you. Tax-advantaged accounts, you must be cautious to follow the distribution rules. If you take money out of a tax-advantaged account for a non-qualified purpose or before certain age limits, you may have to pay tax and penalty on the amount that you distributed. For example, if you took money out of a 529 account for a non-educational purpose or took money out of an HSA for a non-medical expense, these are considered non-qualified distributions. When you make a non-qualified distribution, you must include all or a portion of the distributed amount in your income that year and pay income tax at your ordinary income tax rate, and you'll be required to pay a 10% penalty. When the tax and penalty are added up, it can be a significant amount. Pre-tax retirement accounts have the same tax and penalty if you take money out of the account before age 59 and a half. There are a few exceptions to this rule, but in general, age 59 and a half is the age where you can take distributions without getting hit with a 10% penalty. With Roth accounts, if you take a distribution before age 59 and a half, only the investment gain is hit with the tax and penalty. Again, some exceptions exist. It is important to know what you can take money out of the tax advantage accounts for and when. Next, let's take a look at how much you can contribute to each account type. As we mentioned previously, taxable accounts do not have any limits to how much you can contribute. With custodial accounts where you're gifting money to a child, gift taxes will need to be considered. Many tax advantage accounts do have limits on how much you can contribute to them each year. The IRS recently increased many of these limits for 2023, so whether you're viewing this in 2022 or 2023, the amounts you can contribute for that year are different. Since we're nearing year end and people may be curious about maxing out these accounts, let's focus on 2022 numbers, but I do recommend you keep an eye on the significant increases for 2023. Employee contributions to a 401k, 403b, and 457 are limited to $20,500 in 2022. Traditional and Roth IRAs are limited to $6,000, HSAs are limited to $3,650 if a single person is on the high deductible health plan. That limit increases to $7,300 if you have your whole family on the plan. 529 plans, like custodial accounts, are only limited by gift tax considerations. If you hope to receive the maximum tax benefit for 2022, it is worth checking to see if you are on track to put the maximum amounts you can into these accounts before year end. Quickly, your ability to contribute or receive a tax benefit from IRAs may be limited by your income. If you have access to an employer-provided retirement plan, and if you earn over $78,000 as a single tax filer or $129,000 as married filing jointly, you are restricted from being able to take a tax deduction when contributing to a traditional IRA. The tax deduction is what effectively makes these contributions pre-tax. If you have access to an employer-provided plan and earn over $144,000 as a single filer or $214,000 as married filing jointly, you are prohibited from contributing to a Roth IRA. If you do not have access to an employer-provided plan, these income restrictions are waived. There is a workaround to the restrictions, such as a backdoor IRA, but backdoor IRAs can be complicated with lots of moving parts. If you decide to use a backdoor IRA, we recommend consulting with your financial advisor to ensure the process is completed correctly. We've covered a lot of material here today, but in conclusion, the keys to investing are start saving and investing early to take advantage of compounding investment growth, develop an investment strategy to avoid common investment mistakes, select an appropriate asset allocation mix and adjust that mix based on different periods in your life. Finally, choose the right investment accounts based on your goals and needs. Now, before we let you go, we wanted to make you a final offer as a thank you for watching this video. Our experience has been that 4 out of 5 individuals and their families cannot say with confidence that they're doing the right things. They just haven't put in the work yet. We would love to help. Since you watched this video, we will offer to complete a no-cost review for you. Wondering if you're on track for retirement? We'll crunch the numbers and let you know if you're on track or if changes need to be made. Do you have enough disability and life insurance? We'll calculate adequate amounts of coverage to consider. Do you want to know how much to save for your children's college education? We'll tell you how much and help you identify the 529 plan that's right for you. We can complete a review of your current investments and let you know the strengths and weaknesses and whether or not any changes should be considered. Finally, we can review your estate planning documents. Do you need wills, trusts, power of attorneys? Again, since you watched this video, there is no cost for us to review one or more of the above areas with you. If you would like to take advantage of our offer, please reach out to either myself or Julie, and we're happy to provide you with the next steps. We can be reached at the following phone number and emails. We look forward to hearing from you and assisting you with this important matter. Thank you again for listening today, and as a reminder, please be on the lookout for future videos provided by Medicus. We look forward to hearing from you.